The Fed kicking off a two-day policy meeting today, expected to cut rates for the first time in more than a decade. Here to talk markets and the Fed is Kevin Divney, Senior Portfolio Manager at Russell Investments, and Brian Levitt, Senior Investment Strategist at Oppenheimer. Interesting piece in the Wall Street Journal today, just sort of questioning in the editorial page, just questioning exactly what the Fed is thinking here. It's just everything's so political, you can't help but think they kind of got browbeat into this. But then again, the yield curve is maybe doing the browbeating itself, right, Kevin?
The Fed used to focus on employment and inflation. Those are the two big things, and we've sort of muddled that since the crisis. But to keep the employment numbers where they are, and we're seeing the slowdown in manufacturing and the global slowdown, that's why I think they need to. They believe they need to intervene right now. The other thing, which I don't think a lot of people are focused on, if the Fed cuts here, that has effects in other global markets. U.S. has the highest yields of all the developed markets right now. So I don't know if we're behind the curve or ahead of the curve because we have a stronger economy, but the other effects of our stimulative actions could be felt worldwide.
I wouldn't view it as being politically pressured into this, although it could appear that way from the outside looking in. The reality is the Federal Reserve raised interest rates multiple times last year in what is still a slow growth world and still a generally disinflationary world. So the interest rate hikes last year led to a tightening of financial conditions, a flattening of the yield curve, and inflation expectations, which were coming down pretty rapidly in the United States. So I would say that this rate cut is sort of unwinding what we did at the end of last year rather than view it as this is Jay Powell succumbing to pressure from the administration.
You don't think that the December stock market reaction got these guys saying, I got to look what we did?
Well, yeah, I mean, I think that was ultimately a byproduct of the tighter financial conditions, the stronger dollar, the flattening yield curve. So we've seen this at multiple times throughout this cycle, Joe, where it's a 2% growth world, it's a 2% inflation world, or at least in the United States, and every time policymakers try and tighten conditions, we lead pressure to the market.
That's when you're doing QE and you're taking rates to zero. Yeah. The entire time you should be thinking about, am I ever going to be able to get out of this?
Right.
And when I take the punch bowl away, are people going to be so used to this that there's a bad reaction and we're never going to be able to raise? So this is playing out exactly like the people that were worried. This is exactly what they said. And normal numbers that we used to think would show a strong economy, like a sub 4% unemployment rate or a solid GDP or any of these things that are very positive, suddenly we're saying no. Those aren't the numbers. This is different this time. Yeah. This is inflation. And you're calling it a cycle. 9 rate increases is a cycle? That's like a mini cycle. That's not even, that doesn't even count as a tightening cycle. Well, look, and here we are in an easing cycle already. That could be, maybe they're right, maybe they're not.
Let's think about how far we've come. I mean, we've gone from 0 interest rates or above 2%. We've been unwinding the balance sheet. What the Fed is concerned about is that growth in the rest of the world is relatively weak. They tightened into that. That led to capital coming to the U.S. That led to a stronger dollar. That decreased inflation expectations, and now they're unwinding that modestly. So it's not that we're going back to 0 or we're expanding the balance sheet. They're taking away the last rate hike.
Yeah. Are you 100% sure this is the right move, Kevin, and that the Fed is not sort of succumbing to the wrong signals and almost sort of like saying, okay, we're crying uncle to the markets, to the politicians, to President Trump and everything else? Are you sure this is the right move?
I think it's more to the markets. It's never 100%. But the other underlying thing here is the notion of full employment has been challenged. And Powell said that himself recently.
Well, U6 or something, or people working fewer hours?
Well, there's still a lot of people on the sidelines. There's people coming back into the labor force, and the notion of are we a full employment, and this is the time to stimulate. That's the tension here. And maybe we're not a full employment, and employment could go lower from here. And that is, aside from the trade war, the number one comment from CEOs is wages are going up, and I'm having trouble competing for labor, good labor in their companies.
So that seems to. Then we are at full employment if they're having so much trouble getting people, right? And then they have to I mean, you're making almost another excuse. Like all of a sudden, 3.7% isn't really 3.7%. Is that what you're saying? None of these numbers.
Can we? I think we can go lower.
I know, but that seems like a pretty solid backdrop for the U.S. economy. That it just seems a little weird to be raising rates when you're down, when you've only raise 9. I mean, the next recession, what do you got? How many quarter-point cuts do you got for the next recession? 9?
Well, but don't think of it in terms of the 9 rate hikes. What we need to think about it is if we kept going on the path we were going in 2018, we were going to head into a recession. There was too much money flowing to the United States. The yield curve was inverting. The dollar was strong, so the Fed is responding to that. It's not a matter of
things were so good that we were going to go into a recession. That doesn't make any sense either. You mean the strong dollar was going to choke things off, or something?
Yeah, the strong dollar was going to choke things off. Capital flows to the U.S., the inversion of the yield curve. I mean, we saw it all happening. We were going into a recession in the beginning of 2016 when the Fed raised rates once. 10-year went to 135, dollar rallied 30%. We would have gone into a recession if Janet Yellen didn't back off. So what we were arguing at the end of last year, and we were arguing in May, is that the Fed needs to back off. All the Fed did was communicate a rate decrease, and financial conditions eased considerably, and the markets continued their ascent. So I don't think the Fed needs to be very aggressive in easing. They just needed to back off the tightening stance, because when you're in 2% growth world, do no harm.